already pretty much come back from our initial downturn when we invested. So we're actually outperforming our benchmark by about 3%, which is really good, and we're only down 1% overall. So it's been a pretty happy time for us. This week we are executing the trades for Merck for the for
Possibly Canon.
yeah, and we're also putting more money into the ETF. So we'll be more invested in the upcoming weeks, and hopefully by the time that we go off for summer, we'll have enough money out there to start seeing some real returns as the economy starts to swing back up.
It's about basically all the TA or all the IT people. IT and then.
Yeah, Max, did you want to add anything on the portfolio update?
Yeah, I told him to leave me in. And then this is.
Hey, sorry, just joined. What are you looking for? I didn't hear what you've already updated them. What would you like me to?
I just said like where we were at and the things that we were executing this week.
Yeah. So as many of you know, we sort of got stopped out of the first investments that we made back in mid-March. We kept most of our portfolio in cash for a couple weeks after that, and then we invested starting around the beginning of last week, and we've now made up all of our losses. So from here on out, we are pretty much even, and just trying to add more good positions and add more into the ETF and build up our positions that way. Right now, we're outperforming our benchmark pretty significantly, so we're pretty happy with the stocks we have chosen and the ETF that we're in. But yeah.
And I didn't know if anyone was interested in having Joe Nezzo do a workshop for us on how to do it.
All right, so I'm gonna pass it along to. Thank you everyone for joining. But today we're gonna have a few stock pitches. So we're gonna have it from the industrials and materials sector as well as the healthcare sector. I start off the industrials and materials. Did you guys all get a notification that this is recording?
Yeah, I did when I joined.
Okay, cool. All right, nice. All right, go ahead. You guys can take it away. So that's going to be presented by Max Murphy and Emily Barnett.
All right, so we'll take it away. So we have, let me see here. Can everyone see the screen just to make sure?
Yes, I can.
Okay, perfect. Emily, you want to start here with the company?
Yep.
Cool.
So we are the materials and industrial sector, and it's Max and I. So investment thesis. We chose EMCOR Group as our company for this stock pitch, and they are one of the largest electrical and mechanical construction and facility services in the U.S. It provides a wide range of services, including installation of electric and distribution systems, voice and data communication systems, and environmental controls within buildings. The company's services are provided by a broad range of commercial, industrial, utility, and institutional consumers. So some ESG factors include company-wide emphasis on integrity, discipline, and transparency.
Hey, Emily, sorry to interrupt. Would you guys mind sharing your screen if you can do that?
You guys not see it?
No, we can't see it.
Wait,
I can't at least. I don't know if anybody else can.
Yeah, I can see it.
You can see it, Max? All right, so that's just me.
do the speaker view.
What is it?
No, I'm talking to Steve. Steve, put on speaker view maybe.
Sorry, guys, go ahead.
That's okay. They work in accordance with their environmental handbook, human rights policy, code of business conduct and ethics, and vendor code of conduct. Some catalysts include they're an industry leader, smart energy solutions for their clients, carbon footprint tracking, strong industry growth, and top and bottom line growth. And then risks include the economy, high customer concentration, ties to the government spending, and highly competitive industry. They're in a highly competitive industry and subject to many laws and regulations. Now,
So in terms of the industry outlook, so there's a few industry trends driving this company right now. So a couple of things include advances in technologies and equipment, which allows for improving profit margin and increasing service offerings. There's a lot of consolidation within the industry. So there's some big players right now who are buying up a lot of the smaller guys. Also an acceleration in 100% waste diversion goals and programs is increasing the demand for some of the services offered by companies like EMCOR. There's lots of industry-wide efforts to cut down organic waste, which is great for ESG evaluation. The companies are working to optimize commercial recycling and reused resources, which also drives demand for some of the things that EMCOR provides. There's also, unfortunately, a high recordable incident rate just because of the nature of the construction work within this industry. And like I said previously, it's highly competitive. Some of the material factors include working to reduce carbon footprint. The mainstreaming of ESG will drive investments in talent and infrastructure, which is great. And this vast investment in energy consumption and GSG emissions, local and accidental pollution efforts, which are some of the systems that EMCOR offers for its sustainable sites for its customers. In terms of the industry outlook, so for future growth, recycling, energy conservation, climate change forecasting, and carbon footprint tracking programs are becoming increasingly more popular. Overall, the industry is moving towards a low carbon economy. The industrial sector as a whole has grown pretty significantly since 2008. And this company services a large portion of the industrial sector, so it's very closely tied, even though it's a broad measure. Some key economic drivers include industrial production index, the consumer spending, housing starts, and government investing. So there's also increased integration of technology across the industry, which is great, which is helping drive innovation and also improve profit margins. And then company overview.
Company overview. So EMCOR was founded in 1994 in Connecticut, and they provide mechanical construction, industrial and energy infrastructure, and facility services to commercial, industrial, and institutional customers. EMCOR comprises of 80 operating companies with over 170 locations and employs over 36,000 people. The company was listed number 375 on the 2018 Fortune 500 list. The CEO is Anthony J. Guzzi. He joined the company in 2004, serving as the COO through 2011, and then became the CEO of the company then. Since he became CEO in 2011, the company's ESG efforts have focused on growing environmental issues. They're committed to energy efficiency and tracking their own carbon footprint, and also committed to their company code of conduct and vendors code of conduct. Moving on to risk and mitigation. Some risks include many company projects hold risk for labor-related incidents and accidents. EMCOR's vendors and partners lack to hold the same standards and efficiency as they do. The industry as a whole faces deep diversity issues, general economic conditions, changes in political environment and rules and regulations are a risk, and EMCOR is vulnerable to the cyclical nature of markets in which their clients' operations are dependent on the availability of credit to help finance projects, because they're usually so large and expensive. To mitigate these risks, EMCOR invests in their employees. There are over 1,900 online training courses, mandatory in-person and online ethic and sexual harassment training, and mandatory safety training with over 1,200 good work practices. EMCOR extends their values throughout their supply chain via their vendor code of conduct. This touches upon safety, living wages, and anti-slavery requirements. And EMCOR supports missing and exploited children, breast cancer awareness, and military troop support programs. And they also have their own zero injury program, which is an incentive to keep all of their employees safe. ESG influence. EMCOR mitigates company risk by strictly following their company and vendor code of conduct, emphasizing legal and regulatory compliance, commitment to employee health and safety, honest business practices, conflict minerals policy, fair treatment, hours and compensation, freedom of association, and diversity and inclusion. They also have majority voting for election of directors, and stockholders have the right to call meetings. Moving on to ESG integration. Some material factors are EMCOR operates in an industry that relies heavily on safety standards and regulations to maintain the safety of its facilities, projects and employees. Sorry, I just lost where I was. Incident risk management and reporting is critical to EMCOR, and ensuring anti-corruptive practices when making bids and winning projects. They have an MSCI rating of AA. EMCOR has been awarded the silver medal in recognition of their EcoVadis CSR rating, ISS corporate governance score of 1, and they're a 4-time award winner of CNA safety award recipient. And EMCOR Group is also a gold member of the US Green Building Council. So moving on to mapping to SDGs. They have green buildings, green generation, what was it? A really great waste to energy program. So industrial waste, to have it be provided as a clean fuel source for steam heat and power generation, and energy efficiency program management and consulting. EMCOR is committed to providing sustainable solutions and operating sustainably from an environmental, social, and governance perspective. They strive to maintain low carbon footprint, active in communities where they serve, and create meaningful changes to promote a green future in the industries they operate in.
All right, so now we're going to our evaluation. So first we have our comparable companies analysis. So when it comes to its competitors, EMCOR has some significant advantages. So the company is able to more effectively deploy and utilize its capital and assets to provide stronger returns. So that can be seen with our return on assets ratio here. So their return on assets is 6.5, with the median for its competitors being 4, which means that they are making more money with their assets than their competitors, so they're more efficient. Also, in terms of their debt, it's a lot lower than a lot of their competitors, so they're a lot less levered. And in a time right now where like the company could be doing poorly due to like COVID or something, a lot of companies will be struggling to pay off debt, but since they have less of it, it's less of a threat to their health compared to its competitors. And also their return on equity is significantly higher, which is pretty good for investors. In terms of our discounted cash flow analysis, so let's see here. Yeah, so our upside for our base case was 16.2. A couple things to note is like our perpetual growth rate was 2. Just a few other things here. It'll be on the next slide. But yeah, so basically our price targets, and if you want, you can look at the last slide because there's some relevant stuff on there. But so basically our base case was $77.61, being a 26.39% upside. So basically what we did for this one is for a base case, we assumed that sales growth would decline for this year, and then it would increase the next year and then return to previous levels and then start to flatten out in the future just because of like what's going on right now. So our bull case, we assumed that sales growth would continue at the levels it was before the COVID pandemic. And that would give them an $83.09 valuation with a 35% upside. And then our bear case, was $58.21, being a $5.21 downside. So basically here we assumed that not only this current year's sales revenue would be heavily impacted, it would actually be like the growth would be negative. And the next few years would be slowed as they had to come back and, start like paying off a lot of their debts and other things again, rebuild their cash balance. So that was a 5.21% downside. So in conclusion, during 5 years of share price growth, EMCOR achieved compound earnings per share growth of 16% per year, which is great. EMCOR Group shareholders have received a total shareholder return of 34% over 1 year in the last year, which is really great. Another reason to invest. The stock's expected to fall during the next 3 months with a 90-cent probability of a hold price between $26.85. Oh, wait, yeah, that one's wrong. But so EMCOR has highly diversified revenue stream, which is great for the company. So like Emily said, it makes money from tons of different companies in the industrials industry and provides lots of different services to waste management, to energy management, to construction. So the revenue streams, mechanical construction, electrical construction, building services, U.S. industrial services. And these are all things that, though affected by the business cycle, they're things that are always needed. You know, power generation is a necessity. Building services are in demand. You know, managing industrial facilities. So EMCOR is in a pretty good place in a time like this. The industry that it's in is expected to grow at a CAGR of 5.4% through 2025, which is great. And then also just from an ESG perspective, they engage themselves in construction of green buildings, green power generation, waste energy facilities, and they have an outstanding energy efficiency program that is pushing towards a more sustainable future. And then lastly, so EMCOR works hard to mitigate its environmental impact through many programs, including its carbon footprint program. They maintain close relationships to communities they serve and promote social well-being through charitable programs and safety/risk mitigation protocols. For these reasons, we think EMCOR is a good investment for Bentley Sustainable Investing Group.
Okay, thanks, guys. So just opening it up to questions for group. If anybody has some, feel free to jump in. If not, I have a question. So you talked about their diversified revenue stream. Can you speak a little bit more towards like what it might look like on a percent basis if one dominates the other, like kind of like the distribution on the revenues?
Yeah, totally. So I don't remember it exactly off the top of my head, but I can ballpark the numbers for you. So I know that their mechanical construction is about 33% of revenue. Electrical construction is about like 12 or so. U.S. building services is another like 18. The UK is 12, and then that remainder is U.S. industrial services broadly. So the most concentrated it gets is about 33% in terms of revenue stream, but the rest of them are pretty broken up.
And did they say anything about where they're kind of focusing on moving forward?
Moving forward, they're trying to focus on, they're trying to move so they're getting really involved in building services and industrial services that have to do with like energy efficiency from like an electrical standpoint for like companies that like utilities companies, and then for their building services for like, you know, large facilities, like providing like those green facilities.
Okay.
Any other questions?
Can you go back to your valuation real quick?
Yeah, totally.
As
in the DCF
see
one?
some of these. Yeah. How did you decide on your EV to EBITDA multiple?
Let's see. So are you talking in the bottom right corner?
No, the top left, the assumptions, the 6.4.
Oh yeah, so the EV to EV multiple was, I based it off the competitors.
All right, cool.
Anybody else?
Okay, well, if we don't have any more questions, they sent it over and it will be sent to the group, including everybody on the Zoom right now, so you guys can take a closer look when you start to vote. But thank you guys and good job.
Cool.
Now I'm gonna pass it on to healthcare. So if you guys want to share your screen, that's gonna be presented by Zach and Mari.
Can everyone see this?
Yep.
Okay. All right, put it in the chat if you can't. I also can't see the chat right now. So, all right, we'll see.
No,
how that
you're
goes.
good. You're good.
We're good. All right, cool. All right, Mara, you want to start?
Sure. So, hi everyone. Again, we're the healthcare sector. I'm Mari, and we'll be working with Zach, and we're going to be talking about Edwards Life Sciences today. So, just a brief overview. We're going to walk you through the investment thesis, the industry overview, diving more into the sub-industry that we're going to talk about. We're going to go over the company analysis, their ESG integration, and then finally the valuation. So, here's our investment thesis. So Edwards Life Sciences Corporation is traded on the New York Stock Exchange under EW. It is a cardiac care company. So mainly their subsector is the cardiac care and medical device sector. They have 3 different groups, and that's split into critical care, surgical care, and transcatheter care, which is mainly what we're going to talk about, but we'll dive more deeply into those later. And they grow responsibly considering their entire supply chain and help to further STEM education and continuous sustainable innovations.
We recommend a buy on this stock. On Friday, the stock was trading around $190. Today, it's up to $204. A lot of the market has been on a bit of a run. But when we ran our model, we found a base case. So what we feel it should be trading at now is 218. So if you bought it right now, there would be less upside than a few days ago, but we can get into why it's still good buy. Market cap is $39 billion.
So some ESG factors are their proper supply chain management, their access to health, environmental sustainability, and their furthering STEM education. Some catalysts for the company that we see is that the market for transcatheter treatment is due to see large growth, and that's especially international growth potential. It's not really in Chinese and Indian markets right now, and we're seeing that as we overcome some cultural barriers that we'll talk about later on, that we can see exponential growth in those certain countries. And since Edwards Life Sciences accounts for 55% of the transcatheter market, they really have an opportunity to take advantage of that potential growth.
And some of the risk for the company and the market at large, the political landscape, that's a huge one for healthcare. Edwards Life Sciences, they purchase a lot of their materials from sole suppliers. So we hope that they won't be too dependent on that. Regulatory requirements and COVID-19.
Now for the industry. So looking at the industry, not just the healthcare industry as a whole, but the heart devices market specifically. So some trends that we see is the implementation of new technology, political sentiment around healthcare. So that includes the universal healthcare, but then also we're considering in government regulations. The big thing right now is COVID-19, how that is going to affect the use of cardiac medical devices, how that might increase or decrease depending on different factors. The pressure on the industry for more personalized healthcare. So this goes into the different types of devices that Edwards Life Sciences manufactured. So they manufacture surgical devices for open heart surgery, and then also transcatheter methods, so that accommodates that personalized healthcare based on low to high risk patients. And that also goes off of the growth of minimally invasive surgery. And then one last thing that we want to add is that the US repealed the medical device tax back in 2019 December. So that was a 2.3% tax on medical device manufacturing companies that they had to pay. So that could have hurt revenues. And then trickle down to the net income. And so that was repealed. But the EU is working on an EU medical device regulation for May 2022. So that's something that we will continue to monitor and could be an expense for the company in the future since it is a global company. For future growth, there's a lot of increased disease and therapy awareness. That means that people's diseases are getting detected earlier on than they used to be. And so the implementation of these devices might grow, as before people would already be in high risk and closer to death, and now they're being detected earlier and can be handled earlier. And then the TAVR market is expanding to also treat low risk patients. So if you see the chart on the right, The light blue is surgical aortic valve replacements, and the dark blue is transcatheter aortic valve replacements. So we do see a steady growth in surgical aortic valve replacements, which is good because that is one of the products of Edward Life Sciences. We see greater growth in the dark blue in that transaortic valve replacement, and that is because it used to just treat high risk and medium risk patients, and now it's also expanded to low risk patients. And as we talked about before, it's already present in the US, Europe, and Japan, but we're seeing more rapid growth in Asia as it gets accepted in China and India. And that's mainly because these valves are made from cow skin, and that is cultural significance to Hinduism. And so that is why it's a little bit controversial in India and China.
So some ESG material factors that are relevant to the industry. Sorry. Access and affordability, product quality and safety, selling practices and product labeling, product design and lifecycle management, supply chain management, business ethics. As this applies specifically to Edward Life Sciences, we think that they're a really strong management and board is a good sign for how the company will play into these material factors. The company is known for having really good human capital development, which means that their employees are being trained better, and we see that as a way that economies of scale can increase, so as a qualitative and quantitative purpose. And the company just has really low, I just forgot the word for it, but pretty much there's not going to be a lot of, man, I'm blanking on the word, but it's going to come up later. But yeah, we have a lot of faith in the board pretty much. So the company trades under the ticker EW on the New York Stock Exchange. It was founded in 1958 by Miles Edward. IPO'd in 2000. It's present in 100 companies with about 13,000 employees. But like Mari said, we think the potential of Chinese and Indian expansion can mean huge returns for the company. There's a few business segments. So that's surgical heart valve therapy, transcatheter aortic valve replacement TAVR. That's the one that's growing and ultimately going to phase out surgical heart valve therapy, and critical care. And as for the patents it owns, there's between what they own now and what's pending, that's 4,700, but a large majority of that is what they own now. Recent performance, the company has been outperforming the S&P 500 and has been trading between $155 and $248.
So for the CEO and chairman of the board, that's Michael A. Musalem. He got his bachelor's degree and honorary doctorate degree from Rose-Hulman Institute of Technology, and he now sits on the board of that university. He also serves as member of the board of directors for Advanced Medical Technology Association and the Healthcare California Institute, as well as the University of California. He has been CEO since the company went public in 2000, and then just in 2018, he was named one of management's top 250 by the Wall Street Journal. In addition to the CEO, 26% of the board is female, and that outperforms the industry, which usually has an average about 22% female. And then for their ESG efforts, they have the Edward Life Sciences Foundation, which we mentioned earlier, which grants scholarships for continued education in STEM fields, as well as providing care to underserved health disease patients worldwide, and through a grant called Every Heartbeat Matters. They also focus on anti-corruption and advancement in human capital.
Corruption was the word I cannot remember. Risk and mitigations.
So for some risks, as we said before, COVID-19 is probably one of our biggest risks at the present. It could disrupt the supply chain for manufacturing, and it could also slow down surgeries as anything that's not urgent might be delayed. But we do see that cardiovascular care is an urgent thing. Heart valve replacements do save lives, so we see that those surgeries will continue to happen. But honestly, to be frank, something that is of concern is that people with cardiovascular disease are at high risk if they do get COVID-19. And so people who would be using these valves could be actually killed off by this disease, causing a smaller market of patients. Also, we see less growth in the non-TAVR sectors, so that's the surgical aortic valve replacements and critical care. We do see a potential for increase in critical care due to COVID-19, since they do use those heart monitors in the critical care units that Edward Life Sciences manufactures. And then also the possibility of universal healthcare and increased regulation could cause Edwards to have less pricing power. And then also their product recalls and safety issues. So just past this fall, there is over 1,200 fatalities for the SAPIEN 3, which is their main trans-aortic valve replacement product. But we're going to discuss a little bit more about what happened there in the next slide.
So mitigation. So the company, in regards to COVID-19, stated that they were going to continue investing in high quality technology, continued R&D across the board. And the segments have seen stagnant growth, albeit growth. We think that TAVR can really put the company on its back. And then for that, R&D costs and SGA costs are kind of out of the way. So we think that that product specifically will experience great economies of scale. And as Joe Biden takes the lead for the Democratic Party, we think that the Bernie Sanders model of the universal health care is less of a risk. So there might be less government regulation, but say there is still some increased government regulation regardless of what the healthcare plan is. We think that the market share of this company will ultimately win out, and government regulation will affect all of its competitors. So it's in a really good place competitively. The product recalls have been really transparent by the company. And as Mari said, we're going to get into why those products were actually recalled and why those fatalities happened. And per the MSCI report, product safety issues can be mitigated by strong employee training and strong anti-corruption governments. That's what I was speaking to earlier mainly.
So then for their ESG influence, they established the Edward Life Sciences Foundation, which promotes educational opportunities and surgeries to places with high health inequity. They actually offer a scholarship to their employees' children who are going into STEM education. Then they also, just in response to COVID-19, they gave out $1 million in emergency community grant to partner organizations for financial assistance with food, medicine, and rent to vulnerable communities. Usually they issue these grants in October, but seeing the need of the world today, they decided to do it now. And some of those partners are UNICEF, food banks, the Chinese Red Cross, the Italian Red Cross, and the Spanish Red Cross, just to name a few, but you can see that they're donating to the places that need it most and really trying to globally help everyone. They also implemented the Global Integrity Program, and that works to govern the company's corporate responsibility and hold the board members and upper level management accountable. They map out all of their stakeholders' priorities in order of importance, and then show how the company actually responds to those stakeholder needs in the same order of importance. And then lastly, they are committed to a responsible supply chain. So they require all suppliers to adhere to ethical business practices, act environmentally responsible, and encourage workplace safety and health while abiding by all applicable laws. So this addresses the TAVR safety, which was the cause of the 1,200 deaths this past fall. So basically, transaortic valve replacements are minimally invasive surgeries. They're an alternative to open heart surgery, which is the SAVR product. So if you can see on the chart, the blue line is the resulting deaths, strokes, rehospitalizations in the first year with TAVR, and the red is for SAVR, so that's transaortic versus surgical. And this is a clinical hypothesis tested study by Edward Life Sciences. So originally there was no alternative. We were always at that red line. Everyone had to have open heart surgery, but with the transaortic valve replacement option as a product, now for medium and high risk patients, you can do that minimally invasive surgery, and that is at a less risk. But there are still deaths because surgery is still risky. And what's happening is when they do the transcatheter surgeries, sometimes the balloon that is acting as the aorta bursts, and then they have to do open heart surgery anyways. So the cause of death is just because they have to do open heart surgery anyways, where this product actually makes it less frequent that they have to do open heart surgery, but obviously that is always a risky procedure. So then for their ESG analysis, the material factors that they focus on from the SASB materiality map is access and affordability, product quality and safety, business ethics, environment, and supply chain management. Just to touch briefly on the environmental, they made a commitment to have a 0% change over revenues in energy usage, water consumption, hazardous waste, and everything. And they've actually reduced everything opposed to just keeping it the same and having 0% change. So they saw a 4% reduction of energy usage from 2016 to 2018, a 16% reduction in water consumption, a 16% reduction in hazardous waste disposal, a 2% reduction in solid waste disposal, and a 14% reduction in greenhouse gas emissions. They also set a goal to be 25% below the industry benchmark for workers' safety, and they actually beat the benchmark just this past year by 45%.
So for some third-party data, the Bloomberg Disclosure Score is about 48, and since 2016, that has grown every year. In 2016, it was in the 15 to 16 range. We don't know what the competitors are because we haven't been at school and been able to access Bloomberg in weeks, but we think that the growth speaks for itself. The MSCI rating, that's AA, that's definitely better than its competitors. That has also grown over the past few years. In 2019 and 2020, it was named one of the world's most ethical companies by Ethisphere and has been certified by Code of Ethics. So still very ethical company. We, again, think that that speaks to the board and trust in the board to navigate the material factors as well as just the financial aspects of the company with great strength.
And then just to map these actions to the UN Sustainable Development Goals, they qualify for the good health and well-being, quality education, industry innovation and infrastructure, decent work and economic growth, reduced inequalities, and responsible consumption and production, and climate action.
So MSCI peer benchmarking, for every one of these categories, Edward Life Sciences is either the leader or tied for the lead. It is not lagging behind any of its competitors. And although product safety and quality it's one thing we want to highlight because it is a material factor and it's something that Edward Life Sciences has been dinged on. But if you look at the competitors, it's pretty much on par. And they're trying to invest in new technology to make really risky surgeries less risky. And with any new innovation, there are some bumps along the way. But we think that their investment in R&D and increase in SG&A expenses over the past few years, that a lot of that has to do with companies that they've acquired. So they're trying to bring like more diversity in and increase their resources. So we think that that has caused like some attrition within the company. But again, to their great strength in human capital and development, we think that they're going to navigate that well. And over the next few years, we think that all of their employees and everyone in the lab is going to really make these products a lot safer, even in a relative sense. So valuation.
This is just some sales data to show you the growth of the companies over the past year or so. So broken down by region, we saw the largest amount of growth in the United States. So that was a 23% increase. Europe was the first area where Edward Life Sciences marketed their products. So we're seeing still some growth, but they're pretty established there. So that was a 6% growth. Then in Japan, they're continuing to implement their products there. So that was a 12% growth. And the rest of the world was 11.3% growth. As we talked about before, we do see the possibility of breaking into Chinese and Indian markets. We'll hopefully see some more international growth in the coming years with this company. And then at the bottom of the page, it's broken down by product group. So that first line, that's the transcatheter aortic valve replacement that we keep talking about. That's what's really driving growth. That's at about 20% change just in the past year. Right below it is the transcatheter mitral and tricuspid therapies. So those are actually in clinical trials by Edward Life Sciences right now. So we see that as an additional product in the future and additional growth as that continues to get rolled out. And then we see our surgical heart valve therapy is at steady growth of 10%. We continue to see that at that growth for low-risk patients who can afford to do the open heart surgery. And then lastly, critical care is at about 10% as well growth, but that has the potential to increase with COVID-19.
And if I could add one thing to this. So in terms of the Chinese and Indian markets, we think demand in the international region will increase because, so I know, for example, in India, they have per 100,000 cases of cardiovascular disease or per 100,000 people, there's about 5.6 thousand cases of cardiovascular. So in terms of percent, that's lower than America, but in absolute figures, that's better. That's 60% greater than America. So we think that if the company can navigate or find alternatives to how they make the product in a way that the Indian market seems culturally acceptable, then there's a lot of opportunity there, especially in rural India.
Okay, so here's our comps analysis. Their biggest competitors are Boston Scientific, Medtronic, and ICU Medical, who are all medical device company manufacturers as well. We just want to highlight their enterprise value to sales is double the average and almost double all of their competitors' enterprise value to sales. Also, their PE ratio is the second highest, and their EPS is the highest, showing great value for their sales over the average.
So yeah, the company trades on a relative sense pretty expensive, but we think that for a high growth industry, Edward Life Sciences, given their market share, we think the earnings per share is what's most valuable here, and we think that ultimately that their earnings are even going to increase given their guidance raises, which we'll touch on later. So key assumptions that we put into our model: discount rate 6.1%. It's a really high equity finance company, about like 98% of the company is equity. Perpetual growth rate 2%. EV to EBITDA multiple is 18.5%. A note on that. So you can see that the company's multiple is 26.7 about. So we think that that multiple is it is relative to its competitors, but it is also at a good value. So we think that the base case that we derived is actually really conservative because of that. So yeah, so again, on Friday, the company was trading for around $190, which in the base case gave us a 15% upside. So now some sensitivity tables. Okay, so the tables on the left are sensitivities considering WACC to long-term growth, and then on the bottom, WACC to EV to EBITDA. And the two tables on the right show the returns of those prices derived from those considerations. And everything that's in the thick border, those are what we think are the possible outcomes, like the range that we could be experiencing. So a lot of upside to be had here, especially given the EV to EBITDA multiple being low relative to the company. Furthermore, then we did it again with just long-term growth to EV to EBITDA. Returns are still looking solid. And then given the current interest rate environment, we hypothesize what could happen if interest rates go to zero. And then the base case actually becomes 233.61. So in what we assume that the company should be traded at, if you were to buy it again at $190, you would see about 23% returns, with still a lot of growth. So pretty much the 0% interest rates would decrease the WACC, and it would be in between the 5.1 and 5.6%. So we think that the green scenarios are actually even more likely. And then we did it again with long-term growth to EV to EBITDA, but it's pretty much the same story. So guidance, the company has raised guidance recently in both earnings per share, beat it by 16.5%, as well as sales guidance 5.5%. So we feel really good that the company is, that not only we're confident in the company, but the management is as well. So these are some analyst rankings. These are just on firm-wide, pretty much buy ratings across the board. We see strong price targets, 215 and 230. That's about on par with what we have. And then when you go to individual analysts, a lot of analysts with price targets north of 250. So one in particular, Jason Bedford of Raymond James, his success rate is north of 60%, which for the industry is really good. His price target's 263. So again, back to our green scenarios, we don't think that that's crazy in terms of bullishness. So here are the price targets. We think in the next 2 weeks as COVID numbers rise, there could be a pullback on the current trading price. So consider that our bear case in the 170 to 180. We think that'd be a great buying opportunity. We still recommend buying in chunks though. Base case 218, bull case 278. Mari, you're muted.
Sorry, I was muted. So in conclusion, we see that the 15% upside and the potential 46% upside achieved using our conservative DCF multiples with an unlikely downside creates really strong financial value. Edwards operates in a recession-resistant market, and in one report I was reading, it said it was COVID-19 immune. So providing essential products for essential surgeries that will probably and likely still go on during these trying times. And then lastly, Edwards holds 55% of the growing TAVR market, providing room for growth as TAVR is offered to a larger market of patients with goals of expansion. So again, they're working into the low risk market while they were already at the medium and high risk market. And then hopefully they'll be expanding into China and India in the near future. And then in regards to ESG, Edward Life Sciences' commitment to environmental sustainable practices, responsible supply chain, and funding for access to health and continuation of STEM education add even more value to the firm. And lastly, Edward Life Sciences' continuous investment in R&D mitigates that risk of product quality and safety, and we see further innovation in their products in the future. So that's all from us.
Good job, guys. Really good presentation. Just opening it up to questions now. If anyone on the board or today has any questions for them.
How do I unshare my screen?
I was kind of wondering, so their competitors, so like Boston Scientific, are they major players in the AVR like market, or are they like growing that? Like, what does their R&D kind of like future look like? Do you see like there's going to be a big risk from those competitors?
So in terms of like products similar to TAVR, I don't know what the competitor's market share is. We just know that EW's is, I mean, I don't know, maybe Mari does, but EW's is 55%. But in terms of patents, I know that actually in 2018, EW and Boston Scientific got into like a legal patent dispute. And in 2019, EW paid out legal expenses to like settle those, and there's gonna be no more royalties or anything. But that's pretty much where those companies have been colliding, and we think that those issues are out of the way. So, and pretty much since that EW has been able to maintain its market share, we see it as like the major player. Boston Scientific, they have a lot of different offerings for example, in the medical devices. But for hard stuff specifically, I don't actually know.
Okay, yeah, I was just curious, just because I know Boston Scientific is such a major player, but does anybody else have any questions? Or else, Steve? No.
On my end.
Okay, so then thank you again for presenting both healthcare and industrials. And we're going to come back next week with a few more pitches from IT and financials and real estate. Sasha will be sending out the links for the voting, so that will all go out, including the recording of today, so you guys can go back and watch it if you need to, as well as the office. So you guys can vote, and voting will again stay open for a while in case you guys want to do your own research. And that's pretty much it for today. I don't think that there's much going on for like the rest of the week in terms of other things to you guys posted on. Guys, as soon as we get like portfolio updates from Allison, who's the treasurer, I'll be sending those over to you guys so you guys can see kind of the progress and what our portfolio looks like, our holdings, and everything so far.
Yeah, just one last thing. First of all, great job to both the groups presenting today. But for like some of our younger people in the group, if any of you guys are having trouble with like internship stuff, I know a lot of companies have been like revisiting and canceling, and I know that that's like really stressful and pretty crazy. So I don't necessarily know how much help I can be, but feel free to reach out if you just want to like bounce off ideas off of me or something like that, or see if like I know anyone that might be helpful to you guys. Like definitely feel free to reach out because I know that's like super stressful stuff. So other than that, have a good week, everyone.
Yeah, you can talk to pretty much anyone on the e-board about stuff like that. That totally sucks. And I know that firms are deciding to do very different things. So that's totally unfair to you guys, but we just want to help.
I have a question. If anyone's been involved in a placement day recent, or if like ever and could talk to me, I don't know which sector to choose.
Are you guys doing it through Zoom?
I did it already virtually, and now I have to choose, but I would love guidance.
Oh, you have to rank them? Okay.
I need like a row gamma.
That's what, so that was so funny. My friend Meredith, who's are you at BAML?
Yeah.
Okay, she's at she's doing leverage finance there. She said the same thing when she did hers.
Okay.
I'll just give you her number because she works at BAML, so she'll know the people there better.
Awesome. Thank you.
Okay.
All
Sounds
right,
good.
bye everyone.
Bye.
Yeah.
Bye, thank you.